Hello and welcome to today's conversation with the rating agencies. This is Jim Landman in Kaufman Hall's Thought Leadership Group, and I have just a couple of things to note before we get started. First, feel free to ask questions at any time during the webinar using the Q&A function on the webinar platform, and we will get to your questions as time permits. Second, we are recording today's webinar. You'll receive an email within the next few days with a link to the recording. Today's webinar will be moderated by Jason Sussman, a Managing Director here at Kaufman Hall and leader of our Higher Education Practice Group. Joining Jason today are the higher education sector leaders from the three rating agencies, including Susan Fitzgerald, Associate Managing Director at Moody's Investors Service, Emily Wadhwani, Senior Director at Fitch Ratings, and Jess Wood, Senior Director at S&P Global Ratings. A special thanks to our three panelists for taking the time to share their insights with us today. And with that, I'll turn the webinar over to Jason.
Thanks, Jim. Appreciate it. And welcome everyone to our inaugural Higher Ed Rating Agency panel. Kaufman Hall is one of the leading financial advisors in not-for-profit organizations, has had a relationship with all three rating agencies for as long as the firm has been in business, 35 years. And we have, on our healthcare side, been holding these panels for well over 20 years. And they've been very important means of communication for the rating agencies and for our clients to understand what the rating agencies are seeing in the market, what they're seeing that's important, the issues to be addressed, and so forth. So we're really thrilled to be able to bring together so far two of the rating agencies. Susan, we think, is having some sort of issue in terms of joining us, and we'll join as soon as she can. But let's just go right into this and start with your outlooks. But all of the rating agencies have issued outlooks for 2023 in the past month. And perhaps we can take just a few minutes with each of you. We'll start with Emily to walk through your agency's outlook and some of the issues that you see.
Thanks, Jason, and thanks for having us. We did revise our outlook to deteriorating, negative, and really that's probably no surprise, and it really reflects a couple core expectations that we have for the coming year. The first isn't sort of a no-brainer. The cessation of all of these non-recurring federal dollars floating around and propping up operations are really have ceased beyond fiscal 22, and we won't really see beyond those 2 years of solid support further. We think further infusions from the federal government, and that really could have an impact, particularly on some smaller and more volatile institutions that sort of had some pre-existing challenges as they headed into the pandemic. The second thing that drove our outlook revision to deteriorating really is performance in capital markets. Investment gains fell pretty dramatically last year, and it was a pretty wild and volatile year in terms of market performance, and that impacted pensions and it impacted endowments. And third, again, a headline issue is inflation, and that's having a few different impacts on the sector, we think, really causing a sharp sort of bounce back in operating costs and spending needs to maintain sort of core services at institutions. And again, inflation really has compounded sort of pre-existing challenges around access and affordability on the consumer side, on the student side, and heightened an already high level of scrutiny around the value proposition for the sector. And so we've seen some be successful about really narrowing their focus on retention and completion and time to degree and those components, but ultimately that's going to have an impact this coming year, both on the enrollment side and certainly on the expense side for institutions.
Thanks, Emily. Jess?
Thanks, Jason. I'm so happy to be here. Thanks for having me. I think probably some similar comments to Emily, but S&P published our outlook just about 2 weeks ago now. And for those of you that haven't seen it, our outlook for higher education 2023 is a little bit different. It's mixed. We also refer to it within our report as stable but bifurcated. And this word bifurcated, it's defined as dividing into branches or parts. And we really see that happening in higher education. the trend of, we've talked for several years about the strong getting stronger and the weak getting weaker. And that, we see that, the pandemic really exacerbated these developments, and we see that continuing. So when determining our outlooks, we look first to our rated universe and then also include the external factors that I'll comment on as well, some that Emily's mentioned. We rate over 450 colleges and universities, public and private, and rate, there's a lot of diversity in terms of the type of school and credit quality, spanning from AAA down to CCC. And about a third of our rated universe is BBB+ and below. Only 7% non-investment grade though. But what we saw towards the end of the year, our rated universe stabilized as of 12/31/22. We entered the year with about 86% of our rated universe on stable outlook, but we've seen a lot of downgrades over the past 5 years. When we looked back at those numbers, we downgraded 109 institutions while only upgrading 48. So there's been, over the past several years, there's been a bit of realignment in ratings, and a disproportionate amount of those downgrades were in the lower rating categories. So there's sort of where that mixed outlook comes in. For 2023, we see, I think, a few different impacts. We expect institutions with strong demand, sound resources, and those sort of excellent reputations will probably maintain or strengthen their positions, that they have that flexibility at their rating to withstand some of the operating pressures we'll see this year. But we also think that less selective, highly regional institutions will probably struggle amid growing competition, the higher operating expenses already mentioned by Emily, and just some margin pressure that could weaken credit quality. We do think that institutions at the lower end of the rating scale, which tend to have limited enrollment flexibility or financial flexibility, we expect that these schools will face credit stress this year. And just a couple things in terms of what we're watching, and I'll try not to repeat some of the things Emily's already mentioned, but in terms of enrollment, when we look back over the past couple of years, we've seen mixed enrollment trends across the sector. Post-pandemic rebounds have not been universal, and with rising tuition and other pressures, the debate about the value proposition of higher ed continues. But that being said, the highly selective and very competitive schools, applications have really never been higher, and acceptances are at record lows, and I don't think there's any expectation that that is going to change over the next couple of years. Affordability is also a key area. Inflation, as Emily said, is pervading all areas, and higher ed's really been experiencing rising costs. We're seeing tuition increases for the first time in a couple of years. A lot of schools froze tuition. That focus on affordability continues, but it's getting harder with trailing inflation rates, over 6%. So all of these things impacting parent-student choices, and an increase on return on investment, also means more investments from institutions in counselors, in job placement, all of those types of things. Final couple comments on financials. Operations have generally been strong, but a lot of that was aided by emergency federal funding. And as Emily mentioned, those are pretty much gone. Stable to growing state funding has continued, but for 2023, with those federal funds being exhausted and costs on the rise, we will see some operating pressures for some schools. And then finally on the balance sheet, as we look at, obviously we don't have all fiscal 22 audits yet, but as those have been coming in and we look at those balance sheet results, we don't see that the decline in investment markets in 22 wiped out fiscal 21 gains. We still see absolute levels consistent with, or if not above, pre-pandemic balance sheet ratios generally. But of course, market volatility for this year will remain a question mark. So I'll end with sort of generally, we're seeing a theme of divergence in credit quality, and we expect that to continue throughout the year.
Thanks. So both of you talked about inflationary pressures, and I'm just curious what your agency's perspectives are related to higher ed's ability, how adept higher ed is in reducing expenses. You talked about some increases in tuition, but not really sustainable in the long term. Discount rates increasing. So something's got to give. What is your perspective on this sector's ability to address those issues? We'll start with Jess.
Sure. Yeah, I mean, I think what we saw during the 2 years of the pandemic, we saw schools really get focused on that pretty quickly. But I do think that a lot of the low-hanging fruit, if you will, has sort of already been taken care of as schools have looked at from a cost perspective. I think at this sort of extreme end, in the heart of the pandemic, we saw a lot of schools sort of pause on 401k matches, things of that nature. We saw, freezes on all open positions. We saw some furloughs and layoffs. So I think we saw schools making difficult decisions. And then as federal funding did come through, we saw schools go back, and some of those expense measures that weren't necessarily sustainable were put back in place. So the 401k matches, et cetera, were sort of put back in place. So I think we've seen that schools are able to pivot quickly, but and able to make those very difficult decisions. So we know that if needed, schools can have those levers to pull.
Emily?
Yeah, I think I'll echo some of what Jess said. From our perspective, we saw the same thing. The sector broadly showed a very demonstrable and meaningful capacity to reduce their expenses, particularly at the outset of the pandemic, before federal aid was on anyone's radar. We saw remarkable reductions in operating expenses. Some of that was organic. Travel budgets evaporated in the face of travel bans. Auxiliary expenses fell almost to very little as campuses effectively closed. And I should note, and we noted this, the labor force shrunk. Other than hospitality, education had the highest contraction in labor during the 2020 calendar year, and that persisted well into the first quarter of the next calendar year. This is a sector with arguably more flexibility, particularly on capital, we think, than some other muni sectors. But for most, as just noted, the major outlay is people. We did also see a fair number of reductions in forces and furloughs and the like, freezing of benefit matches. And this is an area for some of really challenging conditions right now, in particular, as we see pretty significantly tight labor and wage pressures in some markets. Particularly those with collective bargaining exposure or a high degree of staff, inflexibility, either related to tenure or other conditions. Finding flexibility elsewhere has really been critical for those institutions. And scale can help. It's not always entirely helpful. And so we did see more pressure on those that had less scale, less flexibility, and just really let a lower level of means to shrink beyond sort of a reasonable amount.
Yeah, so let's pick up on that concept of scale. Obviously, the key to this is growth and ongoing growth of the revenue line. And if tuition increases are limited and discounting is heavy, the only other way to do it is through enrollment or new programs, or the combination of both. So just curious, we see almost all of our clients looking at online and hybrid programs as areas of growth versus actual in-person, face-to-face learning. From the agency's perspectives, how do you look at that? Do you see that as a good thing, a bad thing in a short term versus long term? What's your overall point of view on online learning? So Emily, let's continue with you.
Yeah, we've definitely seen, and certainly even pre-pandemic, we were already seeing a shift toward, incremental shift really up until say 2019 towards online learning and hybrid learning. That's not new. From our perspective, the real where we tend to dig in is partnership agreements. Where do the revenues go? Is there a tuition pricing differential? Are you cannibalizing, more profitable, so to speak, traditional on-campus students, or is it really supplementary? There are so many different modes of online learning. We tend to throw them all into one bucket, but they aren't really all created equal. So we spent a lot of time digging into that. From what we've seen, those that have maximized an arm or a reach into really moving full programs online, have done so very strategically and very methodically, and done so not at a risk of their existing franchise. And I come to you as an MBA from the University of Iowa. The University of Iowa no longer has a full-time on-campus MBA. They're fully remote and fully executive and fully online now. And so we do expect to see that pivot happen. And really for us, the devil is in the details in terms of whether you do it with a partner and there's a revenue or an earnings and net gain sharing mechanism, who bears the cost, and is there caps and floors on how far that risk goes, or if you're going it alone, how strong is your muscle in terms of ramping up new programs and absorbing that incremental cost, and you have the leadership and the bandwidth to execute on that. And more importantly, how does this fit into your deliverable strategy in terms of student outcomes, and is it done in a way to enhance rather than detract from sort of your existing operation? Those are the questions we tend to ask.
Jess?
Yeah, I think I would just add, I think one of the main takeaways from the pandemic is just that some form of remote classes is desirable and hybrid learning is here to stay. So I think schools, institutions that aren't maintaining some type of hybrid learning are probably missing out on opportunity. And this type of flexibility, I think, just remains a key priority for students, not only traditional undergraduate students, but especially non-traditional students that might be working as well, as pursuing a degree. And that's really a key revenue opportunity for institutions, especially when we look forward to some of the sort of demographic cliff potential of, high school graduate numbers declining. I think at the same time, when we look back at fall 22 enrollments and housing occupancy, the rebounds really demonstrate the value that students place on an in-person experience. So I don't think that's going away either. And so I think, most schools have sought to invest in additional sort of online and hybrid programming, but maybe are moving a lot of that investment into the graduate or certificate programs, sort of as Emily mentioned, for their online expansions rather than that standard undergraduate coursework. And in terms of just overall, financial and credit impacts, I think similarly, we ask a lot of the same questions. I think generally we view that hybrid learning optionality as a positive credit factor. Typically, we've seen it have good impacts on overall demand and financials, but obviously there's a lot of questions in there relative to that. So that's what I got.
It boils down to the business plan underlying the strategy.
And just to chime in one last time, and then I'll promise I'll be patient for my next turn. What's really interesting for us to watch is how this changes geographic competitive dynamic. With remote learning, there's maybe 20% of undergrads take a remote learning course from like another state. As those programs grow in number and in quality, that could have a meaningful impact on just how reliant you are on your, geographic diversity and your where you sit geographically in the country and the demographics that you have to live with in that particular neck of the woods. And so for us, that could be, albeit smaller proportion of total enrollment, that's always going to be true, but that could provide some more avenues toward a broader geographic reach and getting out of what could be otherwise in a economically or geographically or demographically suppressed area that you live in. So something to watch.
Thanks. I believe Susan Fitzgerald has joined us on audio. Susan, are you there?
Oh, I really hope I am. Can you hear me?
You are. Welcome.
Thank you. It's been a journey. I'm sorry for being disruptive, but hopefully we've got technology figured out.
We have your voice and your brain, and those are the two important parts for the moment. Perhaps we can give you a chance to give a summary of your agency's outlook for 2023.
Sure, and I was able to hear a little bit of what Jess and Emily said as I was trying to connect. So, you know, I think we have a negative outlook for this sector. You know, we at Moody's we have an entire sector outlook. We can't really bifurcate it like Jess did to talk about different institutions. But I think our view is kind of similar. You know, as we look out at credit conditions, business conditions, there are many that are facing the sector that are all the same challenges: inflation, labor shortages, willingness to pay, demographics, etc. But there are some institutions that are better able to adjust to those. So, you know, I think there's the 1-year outlook, and the 1-year outlook incorporates all of that. And as we're looking at this coming fall, because ours goes through calendar year, you know, part of that, part of what we're really looking at is what happens with fall 2023 enrollment, because obviously this year is kind of baked in. And there's a lot of uncertainty around that. And what we're watching is student behavior going to be the same as it historically has been during kind of cycles and turns and cycles. So during recession, do students go back to school? Some of the changing consumer preferences and student view of value of higher education may change customer behaviors, but I wouldn't say I have that much additional to add to the outlook. But to talk about this kind of hybrid and online, that is certainly something that could impact enrollment trends, right? And it becomes a question of, are you expanding the pie with that kind of delivery mode? Or are you doing the substitution, kind of what Emily was saying? I think the other thing we're watching is that it has the potential to add a lot more volatility to enrollment. So the barriers to entry can be pretty low into that. Not necessarily all of those programs would be of equal quality, but barriers to entry potentially pretty low. So our students, how are students going to choose their programs if they're not bound by geography? It's price, quality, reputation. You've got some organizations out there that are powerhouse on marketing, and maybe the marketing isn't necessarily aligned with the quality of programs, but that doesn't mean it's not going to lure students in. So if you look at where enrollment growth has been across the sector, it's been in some of the biggest online players. You peel out that enrollment growth, and kind of the traditional enrollment is actually down much more than the headline numbers would suggest. So obviously something we're watching play out not only this year, but I think this is a question long-term for higher education. How do students want to study? Where do they want to study? And how do you manage to invest in those online programs at the same time as you're investing in your on-campus experience? So in a way, it expands a pie, but it also adds a lot of potential cost into the cost base, because you're really doing two different delivery modes, both of which have expenses associated with them. So just a lot to play out there.
So when you see strategies like that, online hybrid strategies, what kind of analytics are you looking for to support that strategy and the potential success for that strategy?
So maybe I'll start on this. So obviously,
Sure.
one of the things that we're looking at is kind of pure numbers, right? And it's not necessarily numbers in terms of enrollment, because the compensation per student can vary differently depending on the model of how those programs are being offered. So if an institution has entered into some sort of OPM arrangement where they're contracting with another party, you know, they're sharing that revenue, and the dollar per student that they're getting in from that program may be very different from a dollar per student that they're getting in from a different program. So it's kind of a business segment by business segment net revenue analysis, and no longer necessarily a head count or even FTE enrollment analysis. The headline enrollment numbers actually mean much less in some ways to the economics of an institution than they used to mean.
thoughts from the others?
Yeah, I think the analysis we're asking, and I'm presuming are already being done, are probably the same ones that we're asking for. It's really what's the ROI, you know, what's the run rate. You know, there's obviously the ramp up period, and then presumably some period of what's sustainable. Are we looking for growth or stability? And then ultimately, what does that mean in terms of net tuition, you know, potential going forward? Maybe not maybe less so on a per student basis, as Susan noted, but you know, what are the prospects here? And again, I can't highlight enough what plausible impact does this have on your existing sort of, you know, cohort of students, if any. That's really important for us to understand.
Yeah, I wouldn't add anything really. I mean, I think it just depends on what schools are doing from a strategy standpoint and what type of programming. Oftentimes the programming or the programs are already in place and it's just offering that option online or, you know, in some hybrid nature. But then we're also seeing new programming that's being created specifically for whether it's new degrees and that's being maybe moved online. So I think it just depends.
What about vocational programs and certificate programs? Do you see those in a similar light? Do you think that those initiatives are potentially credit positive, credit negative? Depends on the particular situation. Jess, what do you think?
Yeah, I mean, I think there's growth opportunity there, although for how vast it is from a revenue perspective, I don't know that we've seen definitively. But from a demand perspective, I think, you know, offering a wide array of programming geared toward oftentimes non-traditional students, which is where we see a lot of the certificate programs, is key to the success of institutions and sort of growth in enrollment, especially given, you know, the lowering number, the declining numbers of high school graduates. But a lot of schools already offer certificate programs online. I mean, a lot of schools have been doing that for years. You know, many of the Ivies, a lot of schools have those, and most of the, you know, there's 4-6 week type programs. Many of them are geared towards professionals, people seeking, you know, additional expertise. So I don't know, I can't think of many examples where institutions have shared that those programs are seeing significant growth or adding a significant amount of revenue or significant amount to the bottom line. But I think there is opportunity, especially since the pandemic, as we've moved more and more online or hybrid in nature. I think there are a lot of people out there looking for opportunities where they can do multiple things, where they can be working but also be getting some sort of degree online or certificate. And in terms of the vocational programs, I mean, I think given some of the discussion we've already had about value proposition and ROI, this is a really important area. And we have seen a lot of universities over the past few years really working more closely with businesses in their communities to determine what skill sets are needed for certain job functionality and what courses or programs could be enhanced or added to sort of fit that. So we've seen some examples of that in a lot of different areas, but, you know, under, you know, cybersecurity and just certain areas where I think we're seeing more schools partnering and working with, you know, large, you know, businesses in their communities. So.
Susan, the thoughts on that?
You know, I agree there. We're seeing institutions move into this. It's interesting, you know, and I think where a lot of the questioning around value proposition has been recently has been more in kind of the truly traditional liberal arts colleges. So this concept of can we partner or can we design a program that allows a student to get all of the benefits, and there are vast benefits from a liberal arts education, but still walk away with a certificate or a credential of some sort that they feel gives them that value in the marketplace. I think there's room for that, and we're seeing some creativity around that. So, you know, I think it's both a potential for market expansion that we're also seeing, already seeing some institutions do, but also a way of preserving a market that can be equally important.
So as we talk about investment in programs, we also have to talk about capital investment. And so, Emily, I'm going to ask you to start with this. some institutions during the pandemic held back on capital spending, reduced it significantly. As you talk with institutions around the country, are you finding that those reductions that have created now pent-up capital demand, are they really around maintenance, or are they for investment in new facilities, new growth strategies? And where do you see that spending level going in the future?
Yeah, we're coming off a really light few years of capital spending across the sector and really across munis. And obviously we're still, I think the Fed's going back to their desks this week, and we'll see perhaps another rate hike. We do expect that environment will continue to dampen, we think, opportunistic borrowing, shall we say. And obviously, again, relatively flattened revenue prospects, we think also will keep, leadership teams in a conservative mindset, and really addressing what's necessary in lieu of addressing what's nice in terms of capital. And so we do think that the last few years have really resulted in some pent up, just necessary capital maintenance, deferred maintenance probably crept up over those few years. What we do expect to see is some pickup eventually, particularly as the markets sort of ease and rates ease and conditions look slightly more favorable. But what we're also seeing more and more of are less traditional modes of delivery for capital needs, including lease structures, P3 structures, and again, some real consideration for what's the highest and best use of this physical asset we have on our land. Do we need it? Maybe we sell it. I think a lot of these decisions are so institutionally specific, it's tough to pinpoint a trend, because we did also see during the pandemic in particular, when rates were a bit more favorable, some pull forward financing, some plans that folks were maybe looking at 2023 or 2024 to undertake. They went, while taxable, tax exempt rates were narrower, some opportunistic pull forward financing during those years. And so there is, for those institutions that could get those bonds, transacted, they built up, I think, some wiggle room and some flexibility for the coming years. But we do think broadly across the sector, there's probably some pent up need for just recurring maintenance, honestly, and very likely some pretty serious decisions around strategically what do we need in terms of our capital, and what's the least risky way to deliver that to us in a timely fashion.
Jess, are you seeing the same kind of trends?
Yes, I will second the pent-up need for maintenance and renovations. I think that that's definitely what we're hearing. The average age of plan across the sector is quite high, and so there's a bit of a need for that. So I think we'll definitely continue to see that. Schools are evaluating space utilization, so some of that capital spend might be on renovating to better utilize existing space. I think we've heard a little bit of that. And then in terms of growth strategies, or sort of areas where we might see new capital spend, I think with some of the new programming we've seen over the past couple of years around STEM or healthcare related programs, where you need new labs, and we might see more of that. And also schools reevaluating sort of their mental health and wellness center spaces and some needs there. So those are some of the things we're hearing. And of course, housing plans. As we mentioned, not all schools are still facing enrollment decline. Some are growing, and so the housing renovations and additional housing plans, I think, are a big part of what we might continue to see.
So given all these pressures, Susan, I'm gonna throw this one to you. I apologize in advance, but given all these pressures, do you see a rise or expect a rise in college and university consolidations, something akin to what we saw in healthcare 20 years ago, where the pressures of the revenue pressures created a situation where creating scale, creating efficiencies, and especially on the operating side, but also stronger access to capital, resulted in a huge amount of consolidation. Do you see that happening in the higher ed sector?
Yeah, you know, that's a really interesting question. So I think we're seeing more consolidation among public institutions than privates, and sometimes that's easier to do because there's a state coordinating function of some sort that drives that. We're seeing that obviously Georgia has done it, but Texas is doing it to some extent now. I don't think we're going to see the same thing we saw in the healthcare sector, though, overall. You know, colleges and universities are so focused on their unique and individual missions that coming together can be difficult. You know, they're driven by fundraising. They don't want to alienate donors to their particular institutions, so they're less likely to kind of do that. And they don't have that same concept of a feeder network that you see with healthcare. Although it'd be interesting to see if that played out. We see that a little bit with kind of not necessarily feeder network, but with Northeastern kind of doing more of a regional strategy. So there are a handful out there, but I would say in general, we think it's more likely that we'll see more potential closures of the smaller privates than consolidations. And in part, that goes back to what Jess was saying about age of plant. By the time a small private chooses to go down that path, it may already have a very aged campus, may have lost a lot of enrollment, and may not be an attractive kind of consolidation partner. So more potential closures of privates, although we're not predicting a huge wave of closures. And more potential consolidations or affiliations amongst the public sector would be our prognosis.
Emily, what are you seeing?
Yeah, we do think closures will accelerate, but not at a great clip. This is not a sector that moves quickly in that direction. Many of these are institutions with long histories, long legacies, and deep roots in its donor base and student base, and we don't expect to see you know, a doubling or tripling of closures a year. And really, going into the pandemic, we maybe had less than a dozen of closures in any given year, and the vast majority of those were relatively small private institutions. We do expect to see, as Susan noted, consolidation in other forms. What we have also seen beyond sort of the public state system consolidation of campuses and things like that. Each individual institutions looking to consolidate or right size their own programmatic offerings, you know, making tough decisions about, you know, who do we want to be and what do we want to offer to our students? What can we plausibly offer to our students in the long run, and making tough decisions about scaling back certain programs that aren't delivering on enrollment or outcomes, right-sizing programs. We saw some of that heading into the pandemic, and we think the federal stimulus sort of waylaid some of those efforts, but we certainly expect those efforts to gain energy once again now that those federal dollars are gone, and folks are taking a closer look at their infrastructure, their programs, their athletic offerings, all of those things that have price tags and have been used as recruitment tools. But the question is it effective enough to be worth the outlay? And is this a sustainable model for us going forward? And so we do expect to see some tough decisions about consolidation just within the university itself.
So Jess, I'm going to throw you the same question, but I'm going to put a twist on it. You know, there's consolidation, there's whole organization consolidation and merger, but then there's programmatic consolidation. Are you seeing that, and any expectations around kind of segmented, if you will, consolidation or merger among especially the smaller private colleges?
Yeah, I mean, I think we've already been seeing quite a bit of sort of programmatic consolidation. Just in terms of different areas, Susan mentioned some of the publics and, looking at the public systems, and there's been some consolidation there across different universities and different different campus sites, et cetera. But even internally at individual institutions, I think for the past few years, schools have been reassessing their program offerings And you've seen some closures or, some programs get shut down if there's only 5 students enrolled, or I think schools have been doing a lot of that data analysis and sort of sunsetting programs that just aren't profitable or just aren't making sense or that aren't in demand. So I think there's some of that supply and demand happening. So I think we'll continue to see that. And then in terms of, as you mentioned, partnerships among different schools. So not necessarily, one school absorbing the other or a complete merger, if you will, but just programmatically for efficiencies, for synergies. I think we've seen some of that with especially schools that are located very in close proximity. We've seen some of that where maybe faculty is shared, or maybe certain different types of resources are shared to sort of find those synergies and efficiencies. I think we'll see more of that.
Okay, thanks. So Susan, I'm going to make a little bit of a left turn. A number of the attendees today are colleges and universities with large medical schools. Some are owned, some have spun those off years ago or more recently. But the academic medical centers have been major revenue sources for those universities that have them. Do you foresee, with all the changes going on and the heightened risk in healthcare, let alone higher ed, a change in the strategies at the university level in terms of maintaining academic medical centers within the structure of the university versus spinning them off and having more, I'll call it arm's length relationships?
Yeah, it's interesting, and I've been in the industry, in the sector long enough to have lived through this a couple of decades ago, right? So, and there is that very trite saying of, if you've seen one academic medical center, you've seen one academic medical center, but it actually holds true, right? So we are hearing and seeing strategies across the board this go round, from those that are really thinking of, can we distance ourselves from struggling medical centers to can we pull them closer? So it really goes to the financial, strategic, legal, governance ties. It's a very complex and individualistic conversation, but I would say we're seeing a little bit more of the, we recognize the strategy. We want to kind of pull them in. We don't want to lose it. We recognize that there's some cost and risk to it. I think there were some that spun off their medical centers in that 20 years ago time frame that said, that was probably the right decision short term, but was it really the right decision long term? And if you've got the wherewithal, can you kind of ride the wave? So no, that's not to say that we aren't seeing some potential, and I'm doing air quotes here. You can't see me do air quotes, unfortunately. Contagion risk from what's going on the healthcare side. We are hearing some hospitals that are asking to kind of not do the internal transfers that they may have normally done to support the academic enterprise, or asking for a pause on that. So, there is some financial ramifications for some of the challenges that the hospitals are going through, but we're not seeing, I would say, a wholesale sector-wide rethink of what those relationships are, because I think that those lessons from 20 years ago are still there for institutions.
Are either of the other two of you seeing something different than what Susan described?
I'm not seeing anything different. I will say the reversing of the trend of sort of spinning off hospitals, that's tougher. Some of those motivations that avoiding the so-called university bureaucracy, the time to sort of approval time and required hoops to jump through for capital projects and the like. It's a much more capital intensive, sector. And again, I think the hierarchy and the bureaucracy and the sort of leadership structure that can be, for some, onerous. What we don't see necessarily is that trend reverting back. We've certainly seen a few more get spun off, but again, Susan has echoed this. We have seen this before, and in my former life, I was a healthcare analyst, and we've certainly seen it from the other side. But it's certainly very tough to unwind once done, and the question is, was it the right decision? And ultimately, that's sort of moot, and you've got to make do with what you have. And I will also echo Susan in saying that it's different for each. The structure is different. The dean's tax structure, quote unquote, is different. The partnership roles and how we divide up the strategic plan is different. It's very unique by institution, and so there is no one size fits all answer to that question, I don't think.
So, part of that relationship relates to research. Jess, is research a credit positive? We see lots of our clients who, tout the fact that we've gotten R1 designations and so forth and so on, which we understand. Question is it a credit positive or a credit negative?
I think we generally view that as a credit positive. Where you see most of the R1 designations and the really significant levels of research tends to be at the higher rated institutions, not always, but certainly the diversification of revenues can be very important. And then also I think just reputationally, the schools that tend to have the higher research levels and those R1 designations tend to typically offer sort of maybe greater breadth of programming and have maybe more of a national or international reputation. So we see that impacting, demand as well. So
I'm assuming that Jess speaks for the other two of you in that regard, or?
Yeah.
Okay.
Yeah,
Okay.
I would say, that our assessment would be the same. There's so many of those indirect benefits that kind of outweigh some of the margin compression that you see from doing research, right? Research doesn't make money in and of itself, but it adds to reputation, it adds to donor support, it adds to student demand. So it has all of those knock-on impacts that can be quite positive, even though it often is a money-losing business if you were to kind of fully load it as a component.
Okay. So
Nothing to add to that.
Go ahead. Nothing. Okay.
No, nothing to add to that. Yep.
In the last few minutes here, I want to take a little bit different tack and talk about rating agency meetings and what you all are looking for from this sector as we move forward. So let's start with what makes a good rating agency presentation, okay, and why? Emily, why don't you go ahead first?
Yeah, no, I think it's really probably pretty logical for most. Number one, we hate surprises after the fact. We understand the need for confidentiality and how that might be conflicting with your desire to be transparent. But ultimately, our job is to rate accurately and of course be respectful of confidentiality. But the last thing we want is surprises and the need for any reactive rating decisions. That's certainly not anyone's goal. Beyond that, we spend enough time before we speak with you being retrospective, looking back on historical performance. What we really want to what we really spend the most time on with and find the most value in are your own forward expectations around spending, around enrollment strategy, and more importantly, what's the runway looking like and what's the off ramp if in the event that strategy doesn't pan out. What layers of flexibility do you have to sort of manage to whatever budget targets you've set for yourselves? It's important for us to understand the degree of flexibility that you have and where you might anticipate finding that flexibility, either within your own sort of operating budget or endowment or capital decision making, wherever it may be. Those are the sorts of things that are really of value to us, because we can't get that anywhere else. That's not something that is disclosable. It's certainly something that we spend, I would say, 75% of our time in speaking with institutions that we do rate.
So Susan, would you agree with that, or are there things that, from your perspective, really resonate in the actual meeting and discussion and presentation?
Yeah, I agree with Emily. What does not make, let me start with what does not make a good presentation, which is like a 120-page deck where someone goes slide by slide through the deck and reads the numbers to you. That's not helpful. It's helpful to get that, a few days, at least a few days before the meeting, so that the analysts have a chance to review it. But when we go into a meeting or when we go into a presentation, what's most helpful is the discussion and the understanding of strategy and the forward look. So that's really what we're trying to get out of that, is really kind of an interactive strategic forward look. I agree with Emily, the data is the data. And what we're really looking for is an honest assessment, not really of all of the rosy good stuff, but what the challenges are and how they are addressing those challenges.
So Jess, your comments, and then if you'll add to it, when you're sitting through presentations, what are the things that people are not focusing on that they should be focusing on?
Sure, I will add, when I jotted down a note, the first thing I wrote down was no surprises. So I'll second Emily's comment. I think that's the number one thing, as a rating agency, we don't like to be surprised. So, but also I think I would just add, authenticity and presentation. I think there's a level of preparation. I think most issuers, can read our criteria or read other reports. They know the types of questions we're going to ask or what we're interested in. But also just, we want to have a dialogue. Those are the best rating presentations, when we can have a discussion and really understand the why. That's really where we're coming from. We want to sort of understand the why behind strategic decisions and that type of thing. And just, that issuers should know not to be scared, and that we can keep confidential information so they can share information with us. In terms of areas that, I think most issuers, really do tend to focus on what we're looking for. We typically provide an agenda and sort of some of our questions in advance, but I think in terms of, forward looking, we obviously can read the audits and all the sort of historical information, but really getting a good understanding of how schools are thinking about key challenges or opportunities going forward, and laying out sort of that strategic plan and where the priorities are, and also that, financial planning, that forward-looking financial planning. I think those are the key areas. And of course, becoming always important, but even more so in the past couple of years, enterprise risk management, and just how schools are thinking about various types of risk areas and how they would approach those. And
okay, so there's the presentations that you get that you request for updates, and then of course if there's a new issuance. But if you had your druthers, what would the ongoing communication look like between you and the organizations that you're rating? Susan, why don't we start with you?
Yeah, well, I think we do view it as a long-term relationship. We're rating the bonds over 30 years, now sometimes 50 to 100 years. So like any relationship, communication is key, and that goes back to the no surprises. So we appreciate when an institution has a major announcement, if they can call us ahead of time, because oftentimes we'll get investor calls. We don't like to be caught flat-footed. And we do respect the confidentiality, right? So if you call us, we're not going to say or do anything until there's something public that's out there. But then we have the opportunity to kind of form our opinion and ask an institution questions in advance. So we appreciate incoming calls, but we also do a lot of outgoing calls. So if we haven't gotten that call and we see something in the press, we are likely to reach out. And what we appreciate then is if somebody's on the other end picking up the phone and willing to have that conversation. So from our perspective, it's not a one and done in many cases, i.e. we don't always just reach out just once a year. It can be an ongoing dialogue throughout the year and as situations change. So ongoing communication, just key on both sides, right? We don't want our issuers to be surprised by anything we're saying and doing, nor do we want the reverse.
Emily?
Yeah, I echo all of that. The transparency and the trust is really important to us, and we certainly hope we're worthy of the trust. We treat confidential information as appropriate. Beyond that, I think what I haven't seen, what I've seen a few do, but not all, is provide really deep dives into, contribution margins for programs, areas of risk that, these are not things we put in our disclosure, but this is what keeps us up at night. We always have questions about event risk. How do you handle a cyber event? How would you handle a lawsuit? How, what are those mitigants in place so that when that press release has to come, hopefully to us before it hits the news wire, we're comfortable that you'll manage. We aren't ourselves in panic mode that the rating could be at risk of transition simply because of some unforeseeable event or some plausible but unlikely event. All of those things tie back to the level of high degree of transparency and communication between the two of us, and that's really hard to replace. And certainly that's probably the most important component of what we do.
Okay, and Jess, I'll give you the last word.
Oh no, I would agree with everything that Susan and Emily have eloquently stated. Yeah, I think that transparency and communication is paramount. And I would just add that schools, our issuers, our contacts, they're always welcome to email us. Their primary analysts in between ratings meetings if there's new information, good or bad, that they want to share and keep us apprised of. So that's always welcome communication.
Thanks. And thank you everyone who has attended and listened in. We really do appreciate your attendance, and to the three of you, thank you so much for taking the time to answer our questions and add your insights. I feel like it's been very, very, very valuable. So Jim, I'm going to pass it back to you with any kind of final administrative issues.
Thank you, Jason, and thanks again to our panelists, Emily, Jess, and Susan. As a reminder, look for an email within the next few days with a link to a recording of today's webinar. And thanks again to you all for joining us today.